Imagine you walk into a bank and deposit $1,000 into your savings account. You walk out feeling relieved. My money is safe. Maybe you even picture it sitting inside a giant vault, guarded by thick steel doors, a superhero, or even a dragon protecting your treasure. But here's the shocking truth. The moment you walk out of that bank, your money doesn't just sit there waiting for you. The bank has already started putting it to work. Most people think banks are giant vaults. You deposit your money, they store it, you come back whenever you need it and withdraw it. Sounds simple, but if banks only stored money, they wouldn't make much profit. In fact, many banks even pay you interest just for keeping your money there. So how can they afford to do that? The answer is simple. Banks are businesses, and like every business, they need a way to make money. So instead of letting your money sit idle, they turn it into an income-generating machine. Meet Alex. Alex receives his paycheck and deposits $1,000 into his savings account. He's happy because his money feels safe. What Alex doesn't realize is that the bank isn't letting his money collect dust. At the very same time, Jack walks into the same bank. He wants a loan to buy a car. After checking his application, the bank approves the loan. Now here's the interesting question. Where did that money come from? Did the bank magically create it? Not exactly. A large portion of the money being lent comes from the pool of deposits made by customers like Alex. Instead of leaving deposits untouched, banks lend much of that money to borrowers. At this point, you might be wondering, what if Alex wants his $1,000 back tomorrow? That's a fair question. The answer is that banks don't lend out every single dollar they receive. Every day, thousands of people deposit money while thousands of others withdraw money. Banks carefully manage this constant flow by keeping enough cash and other liquid assets available to handle normal withdrawals. Most of the time, the system works smoothly. But if an unusually large number of customers all try to withdraw their money at the same time, it can create what's known as a bank run. That's why confidence in the banking system is so important. Now let's see how the bank actually earns money. Suppose the bank pays Alex 2% annual interest on his savings. Then it lends money to Jack at 7% interest. That 5% difference is called the interest spread. It may not sound like much, but now imagine this happening millions of times. Thousands of people deposit money. Thousands more borrow money for homes, cars, businesses, education, and credit cards. Every loan earns interest. When you multiply those small percentages across millions of customers, they become billions of dollars. That's why banks don't simply store money. They connect people who want to save with people who want to borrow and earn money in the process. But loans aren't the only way banks make money. Think about all the fees you've probably seen before. Monthly account fees, ATM fees, overdraft fees, international transfer fees, credit card fees. Each fee might seem small, but when millions of customers pay those fees every year, they add up to a significant source of income. Many banks also earn money through wealth management, payment processing, foreign exchange, and other financial services. Holding your money is only one small part of what a bank does. The next time you deposit money into your bank account, remember this. Your money isn't simply sitting inside a giant vault. It's part of a much larger financial system. Banks take money from savers, lend it to borrowers, earn income from interest and financial services, and keep money moving throughout the economy. Once you understand that, you stop seeing banks as buildings that store money. You start seeing them for what they really are: businesses that make money by putting money to work.